Hello and welcome to today's ACM Tech Talk. This webcast is part of ACM's commitment to lifelong learning and professional development, serving a global membership of computing professionals and students. I'm Andrew Rosenfeld, a Senior Vice President at 2 Sigma, where I've spent most of my 20-year professional career. And I'm currently in the AI core group alongside today's speaker, David Kriegman. For those of you who may be unfamiliar with ACM or what it has to offer, here's more information. ACM offers educational and professional development resources that bolster skills and enhance career opportunities. Our members can stay competitive in the constantly changing world of computing with a range of ACM Learning Center resources at learning.acm.org. You can see some of the highlights on your screen. ACM recognizes the role of computing in driving the innovations that sustain competitiveness in a global environment. ACM provides access to the ACM Digital Library, the world's most comprehensive database of computing literature, leading publications and global conferences that draw top experts on a broad spectrum of computing topics, support for education and research, including curriculum development, teacher training, the ACM Turing and ACM Prize in Computing Awards, and the ACM Code of Ethics, a collection of principles and guidelines designed to help computing professionals make ethically responsible decisions in professional practice. ACM enables its members to solve critical problems using new technology that enriches our lives and advances our society in the digital age. Before we get started, I'd like to quickly mention a few housekeeping items shown on the slide in front of you. If you have questions at any time, please type them in using Zoom's Q&A feature. I'll organize the questions as David speaks, and we'll try to get to as many as possible after the talk. This session is being recorded and will be archived. You'll receive an automatic email notification when it becomes available. And check learning.acm.org for updates on this and other upcoming webcasts. At the end of the presentation, you'll see a survey open on your screen. Please take a minute to fill it out to help us improve our tech talks. Today's presentation is Deep Learning for Sequences in Quantitative Finance by David Kriegman. David Kriegman is on 2 Sigma's AI core team, as well as a professor of computer science and engineering at the University of California, San Diego. After receiving a bachelor's in electrical engineering and computer science at Princeton and a PhD in electrical engineering from Stanford, he joined the electrical engineering faculty at Yale and then the computer science department at the University of Illinois, Urbana-Champaign. David's core research is in computer vision and machine learning, and he has applied this to face recognition, robotics, coral ecology, medical imaging, microscopy, computer graphics, and more. His papers have been cited more than 50,000 times, and he has received Best Paper awards at the 3 major computer vision conferences. He was the editor-in-chief of the IEEE Transactions on Pattern Recognition and Machine Intelligence, and he's a fellow of the IEEE. David co-founded 2 companies, and KBVT, which developed face recognition technology, was acquired by Dropbox in 2014. Subsequently, he led the machine learning team at Dropbox. David, without further ado, please take it away.
Thank you, Andrew. Let me share my screen for the talk. We will get started. Okay, welcome everybody, and thank you for that kind introduction, Andrew. Thank you to the ACM for inviting me to speak, and welcome everybody who's out there. So at UCSD, I taught an upper division graduate course on deep learning for sequences. And then in 2019, I gave a short version of that class at 2 Sigma. And today what I'd like to talk about is show you how deep learning for sequences can be applied in the quantitative finance field. The lecture itself is oriented towards folks with a minimal background in finance and machine learning. And some of you, I'm sure, have a background in one or maybe even both of these fields. So I hope for most of you, you'll get something out of the area that you know less about and maybe pick up something at the intersection of these 2 fields. Again, if you have any questions, feel free to type them into the Q&A tab on Zoom, and Andrew will ask them kind of in bulk at the end. So let's see. So 2 Sigma is a highly regulated industry, so I've got to put this slide up here. Don't bother reading it. Let me give you first a sense about where I'm coming from. I don't think UCSD particularly needs an introduction, but let me say a few words about Two Sigma, which people may know less about, particularly the computer science folks, people more on the tech side rather than the finance side. So Two Sigma was founded about 20 years ago as a quantitative hedge fund and now encompasses a number of different businesses. Two Sigma Investments, and that's part of where I'm working, is that quantitative hedge fund that started the business. And it primarily takes investments from institutional investors such as pension plans, university endowments, and so on. And it aims to meet certain investment objectives. Of course, that's earning money, but it's earning money in a safe way for those investors. Two Sigma Securities is another one of our businesses. It's referred to as a broker-dealer business that directly touches the markets and trades a heck of a lot of shares by anybody's accounting, hundreds of billions per day. Then those are businesses that touch publicly traded markets. And then there are three other businesses: Two Sigma Venture Capital, Two Sigma Private Equity, Two Sigma Real Estate. They're more concerned with private investments. All these businesses use scientific methods, things like data analysis, hypothesis-driven experimentation, and technology to make decisions. So there's a lot of science, and we use the word financial science to kind of qualitatively describe what we're doing. Two other businesses are involved in insurance and providing solution platforms for investors. The company itself is 1,600 people. We're located around the world. Within Two Sigma Investments, we're located in New York, Houston, London, Hong Kong, Shanghai, and Tokyo. And the firm has 600 people with advanced degrees. About 200 of them are PhDs. And interestingly, for most people, there's a very, very large number of computer science and tech people that do not come from a finance background. And 2/3 of the people work in research and development. So much of the environment feels very much like if you were at any other, large, mid-sized, let's say, tech firm. All right, on to the topic of the talk: deep learning for sequences applied to quantitative finance. So let's first talk about sequences. Okay, a sequence is simply an ordered list of elements of some length. We don't deal with infinite sequences. Everything has finite length. We're going to be able to compute on them. Those sequences, the elements of them will differ depending upon the particular domain of application of deep learning. So for example, in a sequence might be text, and text would be a sequence of either characters or the words that comprise the text, depending on how you parse it out. Speech is a sequence. It's the audio signal that comes in that's digitized at some number of samples per second. Music is similar. Video would be a sequence of frames. So the elements are photographs of the sequence, and then the video is the list of them, the ordered list. But those tend to be fairly structured sequences. A little less structured might be the sequence of web pages that you visit when you go to a web page, or to an e-commerce site, I should say, the sequence of pages. And then in finance, one of the most kind of fundamental sequences is the sequence of trades that happen on some market. And in the good old days, that was the ticker tape that explicitly presented that sequence. Now, sequence processing tasks that deep learning might be applied to take a sequence in as input and then output another sequence. Those sequences might be different lengths, and I've denoted that here the length of the input sequence is x, is length nx, and the output sequence y is length ny. Again, these may differ depending upon the task. So an example sequence processing task might be sentiment classification. You look at a review on your restaurant application of choice, say Yelp, and you see a review and it says, Jenny loved it, their banh mi is sick. Is that a positive review or negative review? That's what we mean by sentiment. How does that reviewer think about it? And that particular, expression has words in it just at the word level. Loved sounds super positive. Sick does not sound so good. Ask my mother that, and she's like, it does not sound like a good restaurant. Ask somebody under age 40, and yeah, that's a great restaurant. They make some really good food. So anyway, that's an example of a sequence. Input is the sequence of words, and the output in this case is a sequence of length 1, the sentiment. Another one with output length 1 might be video activity recognition. you've got a video and you're asking what are the activities that are being performed in that video. There might be one or more activities, but there's basically not a sequence, but a single element coming out of it. Image captioning flips this around. You take an image in and the output is a sequence. Single input, output, arbitrary length sequence. Recommendations. You look at a set of observation and you might recommend a product. You might recommend what web page to go to next if you're doing search, and so on. Machine translation. Here's an example where the input is a sequence of an arbitrary length, and the output will be another sequence that's a different length. Different languages have different grammatical structure, and so it's not a word-to-word translation, it's a translation of an expression or sentence, which again might have different lengths for input and output. Speech recognition, audio sequences samples in bits per second, and the output is text, again, very different lengths. And prediction, something we'll talk about here more so, takes a sequence of elements in over time and is producing out a sequence of the same length, essentially forecasting or predicting what the next element would be at a given time. So the output and input are pretty much the same length, plus or minus maybe a little bit of warm up in the beginning before you're ready to start outputting elements. So those are sequence processing tasks. Here's one potential sequence. It's the stock prices over a 1 month period of Dropbox and what its price was during that time. All right, now let's talk about finance a little bit and talk about how do you make money in the stock market. So I'll put up some, common ways that we would say how you can make money. All right, most basic thing, buy low and sell high. So if you bought Dropbox in the beginning of this month at day 24 and sold it at the end of the month, you made money because you bought it at a price that was lower than the price when you sold it. Other ideas that you hear, about how to make money: buy the dip or sell at the peak, as its converse. And shown here in purple is kind of that strategy implemented, usually done in retrospect if you know where the peak is, and you do a lot better by buying the dip. All right, another idea about how you make money in the stock market: don't put all your eggs in one basket. Well, just because one company looks to be good, it might be good today, but not tomorrow, and it's usually better to diversify. Don't time the market. These are things you're sort of told by newspaper articles and so on. My answer to that is yes and no. I mean, if you're buying the dip, it's exactly what you're doing to time the market. And if you're going to sell high, well, you have to make a decision when to do that. So one of the things you have to think about. And the last idea that kind of comes up is don't let your emotions cloud your decisions. Don't hold on to something just because you thought it was good. Don't sell because you got kind of sort of scared and so on. So in quantitative finance, we kind of take these ideas and apply that in a quantitative way. And certainly in the last one doesn't come into play because with everything is algorithmic or algorithmic driven. So let's take a look at the quantitative investment pipeline. This is how we kind of make decisions. On the right-hand side are the markets where we might be trading. So those are things like the stock markets. It might be in the US, NASDAQ or NYSE, New York Stock Exchange. But it might be other markets. It might be non-US stock markets or equity markets. It might be trading in currencies. It might be trading in cryptocurrencies. It might be trading in futures. It might be trading in options. Each of these things has a market associated with it. And to make a decision, we take in data on the left-hand side and ultimately make decisions about what to buy or sell on that market. All right, that pipeline goes through a stage of feature extraction, what's referred to as alpha modeling, portfolio optimization, and execution. And I'll march through each of these, not in order, but we'll go through each of these boxes and kind of explain what each of these steps in the pipeline are, and then we'll see how deep learning can be applied to some of the stages of these pipelines. All right, so let's start with the first one, alpha modeling. This is the second one in that pipeline. So here, this is the sort of core forecasting problem or prediction problem. Given information about a financial instrument at time t, so over here and all this past history of it, what do we think the price is going to be at time tf? Will it be going up or down? A simple binary decision, or predicting what the actual price will be. So an alpha modeler, one alpha model strategy is, let's just look at that historical and consolidate to one number, the average or the mean. And then let's look, is the price at the time t that we're at high, above or below the mean? And basically we're going to think, you know what, if we're above the historical mean, it's probably going to go down. And if it's lower than the mean, it's probably going to go up. So in this example, the mean is below the current price at time t. And so our forecast is that it's going to go down. And indeed, that's what happened in this particular case. All right, so that is referred to as a mean reversion alpha model. No deep learning in this. It's, you know, based on experience. Things seem higher than they were. We think it's going to drop. However, there's another one that kind of runs opposite of this, which says, all right, here's a sequence up to time t. What do we think the future is going to hold? What's it going to be at time TF1 and TF2? And instead of saying, well, at both of those, it's going to go back to the mean, it's going to revert, is, hey, we see this nice upward trend. That upward trend, we can fit a model to it, even a straight line, or do linear regression. And we expect that linear model to kind of continue into the future. So it's going to go up higher at TF1 and even higher at TF2. And in fact, that is the trend that was kind of observed. It's pretty close at TF1 and a little undershooting actually at TF2. And this is sometimes referred to as a momentum alpha model. All right, these are examples of manually defined, or they're algorithmic. There's an equation that sits behind it, but not a learning-based model. All right, so this is an example with it. All right, and what you'll note here is there were two types of forecasts here, one at TF1 and one at TF2. And when you're doing forecasting, there's a question of when do you expect that to happen? And the time horizons may be different. You may expect something to kind of go up in the short term, but actually regress to the mean over a longer period of time. And those are not inconsistent conclusions. All right, back to the pipeline. So that was the alpha modeling stage, the one that really looks like, man, that looks like something where we might be able to apply a deep network for doing forecasting. All right, let's talk about the earlier stage, the data that would go into that alpha model. So it could be the raw data coming in, it could be the ticker data coming off the last trades on the market, or we might look at other things a little bit more along the that are derived from that, or coming from other sources of information. So things like the price coming off the ticker are typically referred to as technical features. They're the price of the instrument, what it's selling for, and the price that it's being sold for is different than the price that you can buy it at. There's usually a spread between those two, and that's referred to as the bid-ask spread. There's the volume, how much is being traded. If something's being traded a lot, usually the bid-ask spread is tighter, they're closer together. And it's an indication of how much interest there is in that stock at a given point in time. Might be an indication about whether it's a good time to buy it or sell it. All right, so those are referred to as technical features. Another feature that gets used are referred to as fundamental features. These are more around intrinsic properties of the thing you're actually investing in. If it's the stock market and its companies, well, it's how's that company doing? You might get a quarterly report every quarter, giving you an indication what sales were, how those sales increased, projections about what the future will be, changes of the business, income, cash flow, debt. Those are all fundamental features that will influence the price of a stock. Another thing is, well, those are about the companies, but the market isn't fully connected to what the companies are doing. And what the company reveals through their performance reports is not the whole story about the company is doing. And a lot of that comes in through external sources. There are news reports and social media and analysts commenting on it, and their feelings, what you can get out of that gives an indication about how the market will move. The market itself has, millions and millions of participants. They're all making decisions. Should I buy? Should I sell? And it's not just what the company does, but it's how the market is feeling. People participating in that market are feeling about it, and that's going to affect the prices. So another area to use. Finally, there's sort of non-traditional sources of information. where you might glean information that indicates in advance how the fundamentals will change for that business, how the sentiment might be. Examples might be, if you count the number of cars in a parking lot and compare it historically at a retailer, you might know whether business is good or bad relative to previous times and how the fundamentals are likely to change, and in turn, how the prices are going to move. The amount of crude oil sitting in a tank might give you a sense about how oil futures might go. Container ships backed up in LA might give you an idea about flow of goods into the United States from Asia. And that might tell you something about how the currencies between these countries might begin to shift. All of these are some of the features that might be used as input to an alpha model. All right, moving along the chain a little further is portfolio optimization. All right, let's say we have predictions for every stock traded in the United States. How should we actually deploy our capital? Should we, if these are examples, let's say from the Dow Jones Industrials, of what we forecast the price to be, not whether it's actually going to be what we forecast it, where should we put our money? Procter & Gamble in this case is thought to be going up the most. Should we put all of our money in Procter & Gamble, or should we do something different? And the answer to that is not simple. Should we go in all in Procter & Gamble? There's a number of issues to consider. For one thing, it's how much do we already hold of each stock? We make the decision. It's not like we're coming with a big pile of cash. We're already in positions, and it's going to cost something to maybe make those trades. Do we really believe these numbers that are here? How confident are we in these forecasts? How volatile are the prices? Have they been going up and down a lot? And so this is like, we're going to expect significant changes anyway. How tolerant are we to risk? If we go all in on one stock and it doesn't pan out, do we end up losing a lot? What if something, a war starts? Imagine that happening and how that will affect prices. Should we diversify? Should we concentrate in one area? If not, how do we measure diversification? How much and what we intend to it? Again, how much does it cost to trade? If we already hold a position, to move out of it, it may cost us something. Anyway, all of these issues can be combined together and they form a large-scale optimization problem that is then solved. And the output of that is how much of each of these stocks we should hold. So the forecast predicting the future is only a piece of it. The other piece of it is how we bring all these together to decide where we want to actually be. All right. The last piece of this pipeline is the execution. When we've decided we want to have a portfolio that let's say we want to have $100,000 of Procter & Gamble, which was the leader in that pack. We want to have 70,000 of Apple. We want to sell, I don't remember what was down at the bottom. So we have a set of changes that we want to our portfolio to make. We then have to actually go to the market and buy or sell the shares that we want. And it's the market itself will have changed even during the time that we did our prediction. There's a lag in there, and it may take a little while to sell. If you want to sell a whole bunch of stock all at the same time, it's usually not a good idea to get out there and say, hey, I want to dump $10 million of Apple today. It's probably not a good idea because somebody on the other side is going to say, they're getting rid of a bunch. Let's lower the price a little bit because we know they want to get rid of a lot of those shares. So you have to figure out how you're going to execute. And that's the execution side that actually decides on placing those orders. All right, so we've seen the pipeline of quantitative investment divided up into these 4 steps. All right, I just actually said all this stuff on execution. Well, let me go through this part on execution for a second here. So the execution problem also is you've got these orders that you want to place. Should those large orders be broken up into smaller ones? Where do you actually trade it? There's not just one exchange. It's not just the New York Stock Exchange. They're traded on a number of other exchanges. And what type of orders to actually place? It's not just buy or sell. There's other kinds of orders which we could choose to place. And that's what execution is responsible for. All right, so that's the pipeline. All right, now of these steps, 3 of them very much look like sequence decision-making problems. There's feature extraction that's coming in over time. Alpha modeling takes in a sequence of features to forecast the future. And then execution is going to take a sequence of trades to come in, but it's also going to produce a sequence of possible trades that are going to go out. It may not be one trade to execute at a time. It may be breaking things up. And so each of these looks like sequence decision-making problems. All right. So back to the, again, topic of this talk. It's not just quantitative finance, it's deep learning for sequences in quantitative finance. So we've now seen a number of different sequence problems in finance. Let's turn our attention now to deep learning for sequences, and in particular, start from the beginning of this, which is deep learning is built on neural nets, and neural nets, it turns out, are actually not a new idea, even though they've really grown in effectiveness in the last decade. They go back from before I was born. Frank Rosenblatt implemented the first analog perceptron as recorded in 1958, article in the New York Times. So the first one was called a perceptron that he implemented. It was doing recognition of characters. He was at Cornell, big Cornell C there. Observed by a camera, the pixels were, it was a pixelated image, and it was going to classify the character that was in front of it. So that was 1958. A lot's happened since then, boom and bust and so on. Now we're in boom. What's changed since 1958? Well, the architecture that he used of his neural network was exceedingly simple, but still fundamental today, the perceptron. That's changed. We now have massive amounts of data, and that's turned out to be really important, that these architectures can absorb and handle these large amounts of data, and they're actually available, part due to the internet and part due to all the ways and places we can get data. There are new training algorithms that have proven to be much more effective than what was done earlier, that allowed networks to become larger and handle this large amount of data effectively. And finally, there's the ability to actually implement the training of these bigger networks with massive amounts of data on these really big architectures using parallel computation, using things like GPUs and TPUs and so on. And even the CPUs have gotten fast enough to be able to do a lot of what could not have been done, 1, 2, or 3 decades ago. All right, so Rosenblatt's perceptron. It's still used. The same core idea is still present, though it's a piece of a deep network. The basic idea of the network is that you have a set of input numbers, D of them, X1 through XD. The network is going to produce a single number output of a perceptron, call it Y hat. It's typical lettering that we use for symbols here. X is input, Y is output. And what the single perceptron is doing is it's taking a weighted sum of the inputs, W1 through WD are the weights. So X1 times W1 plus X2 times W2, the weighted sum, or dot product, if you will, of the input times the weights, adding another bias term W0 to that, and then pass through a nonlinear function referred to as an activation function. Written out here as equations and all that for people that like that part of it. But that was what the perceptron did. The activation function for Rosenblatt was just a simple threshold. Other ones that do get used now are sort of a soft threshold. It's referred to as a sigmoid, kind of maximum at 1, minimum at 0 for the input and output when things are large, and then kind of a linear realm in the beginning, 10H, which is very close to that. And then something that's gotten very popular in the last decade is the rectified linear unit as that activation function. So that's the core, a perceptron. That's what Rosenblatt used. Then the next thing was to add more layers and more outputs to this, commonly referred to as a multi-layer perceptron. It's just take that single perceptron unit and replicate it horizontally here in different intermediate layers referred to as hidden layers, and then more outputs, Y1 and Y2 as multiple outputs. And the equations now you can turn them into, instead of seeing it as a summation, it might be easier to accumulate the weights for the first layer into a matrix and the weights in the second layer also into a matrix, and then view this as matrix multiplication. And so these weights are commonly referred to as the weight matrices, the combination of all of them. And when we train a neural network, what we're doing is we're estimating or learning values for W1, W2, and the weight matrices given a fixed size or shape architecture. Note that the network itself forms a directed acyclic graph, and that turns out to be important in how we actually kind of do training for this. This is a 2-layer network. Deep networks are generally viewed as networks that have more layers than just 2. So 10 layers, 152 layers, depending on how deep is desired for the problem. All right, so that's a neural network. Now let's look at a neural network for sequence modeling. All right, and let's just use the simplest thing, what we've seen so far, using a multi-layer perceptron to predict the price of a stock, what it will be tomorrow, given the history part of it. This alpha modeling problem, which we'd seen previously, could be implemented using these straightforward methods, but now let's make it a learning method. So we're given as input a sequence of the prior stock prices, let's say P1 through PT, and we're going to predict the stock price at time t+1. All right, we have our multi-layer perceptron neural network, which takes D inputs to it. We have our sequence that's going to be the input to this. Now, typically T will be larger than D, will have more history than inputs. So we're only going to take the last D parts of the sequence as the input, or have to do some feature extraction to kind of summarize the first P1 through PT time events and maybe make that an additional input. And the output, well, we only need one output for the prediction problem. So it's a prediction of PT+1 for that one output. So this is like a 2-layer perceptron implementing the sequence processing task, just using the prior history. Now, I said training amounts to estimating those weights, the W1, W2 for the 2 layers of a 2-layer network. To train the network, we need examples of the prior history, what has happened. And that's pretty easy to pull out of a time sequence like stock market prices. You just pull up the past history and you say, I'm going to take every subsequence from some initial time to time PT plus to PT, and then take the next one as the truth. So our training data is going to be a sequence pair, the history P1 through PT, and the next value PT+1. And the index up here, I, is the example that's being used. So there are M examples of sequences and their forecasted next value. So we take our network, and for each training example, we put it into the network. We get our forecast out of the network, PT+1. We have our truth about what actually happened from our training data. So we have these two things that we can compare, our forecast and the actual future that happened. And we pass that through a loss function that's going to compare them. And that loss function is going to be small when they're the same or close, and large when they are different. And so examples of functions might be just take the difference between the predicted value and the actual value, take their difference and take the absolute value, or square that absolute value. L1 or L2 are typical losses for this kind of pattern. And then the total losses, add that up over all of the training data. And then training is going to be, okay, that's when I pick a value of W, that's what the loss is going to be. But now what I want to do is minimize the loss, adjust the W's to minimize the loss. And again, that's what training does. It's a process of finding a W that minimizes a loss. And the process of designing a neural network system involves getting the data, deciding the architecture for the network, defining a loss, and then figuring out an optimization strategy that is actually going to adjust the W's to minimize the loss. Now, the reason why this becomes a tractable optimization problem for neural networks is twofold. One is the network, which I mentioned previously, is a DAG, directed acyclic graph. And in turn, that allows us an easy way to compute partial derivatives of the weights with respect, or the loss with respect to the weights. We can do this by applying the chain rule repeatedly. This is sometimes referred to as backpropagation in the neural network literature, but it allows us to propagate the changes to the loss function as we adjust the weights, or the other way around. And so that leads to an optimization strategy that is related to gradient descent or hill climbing, local techniques. And they go by various names that are used: backpropagation, stochastic gradient descent, fancier ones like AdaGrad and Atom, and so on. Now, each of these methods is, again, basically a local optimization technique that is making steps to minimize the loss. And the area of optimization, of course, is a huge field, lots of interesting problems. It turns out in neural networks, we're using, in a way, some of the simplest optimization techniques, just the gradient-based methods. We're not looking at Hessians. It's not doing anything that's even as fancy as Leverberg-Marcotte, never mind global optimization methods. And the reason for this is the size of W can be extremely large. So we might here be talking about networks with thousands of parameters, but some of the largest neural networks today have billions of parameters. And there's work to say, how do I train something with trillions of parameters? And so things like Hessian matrices grow by the square of the number of parameters. And so it would be completely intractable to actually compute that, to have enough data to do it reliably. All right, so that's how neural networks get trained. For better predictions now, if we're doing quantitative finance, I said the input is the price for this network, but really the price is just one feature we might use, and we listed 4 different sources of information. So at each timestamp, we could actually have a vector of inputs, not just one input. So that will typically give us much better predictions than just using one feature, using more of them. All right, so that's how we can use a multi-layer perceptron as a prediction, sequence predictor. The problem with it, however, is that with a fully connected network is for n features and d timestamps, there are many, many weights, and learning them can be extremely difficult with limited training data. So, there's d times n weights, and again, can become, you look at 100 previous steps and you look at a 100-dimensional feature, and suddenly you get a very, again, large number of weights in that first layer. So instead, there are a number of alternative networks. One of them that's commonly used is a recurrent neural network. And recurrent neural network basically introduces a feedback loop into the system, going back from the hidden layer and feeding back. To train a neural network, we have to turn it into something that is amenable to gradient descent. So we basically unroll the network, which had that feedback loop, which would not be a directed acyclic graph, into a directed acyclic graph by saying we're going to stop at a certain number of steps, say d steps, to a sequence length of d. And when we do that and unroll the network, now the network looks like a DAG, but in this case, the weights are shared between the various steps. And this is a deep network. It's as deep as the number of steps in your sequence. All right. The problem with a lot of these networks is that they're hard to train. They're very, very deep. And so they need ways to regularize the networks. This is introduce certain parts of it so the gradients during the steps don't explode, or that they don't go down to 0. And then it turns out the simple network probably doesn't work so well. And so we've moved mostly to other kinds of networks that have gates in them. I'm going through this very fast because I really want you to get a flavor for this approach. A gated network uses something different than just the activation function and linear layers. They're pieces of it, but the gate itself is, instead of being linear weights and a nonlinear activation function, introduces a bilinear layer that multiplies the gating signal together with the inputs. So the gates introduce this bilinear layer in there, and in turn, that, when appropriately architected, leads to a much more stable network. So one of them that is commonly used is called a gated recurrent network. And I'm looking at the time and I want to leave time for questions. So I'm not going to get into the architecture of this in any detail or no detail. So there's the gated recurrent network, and there's the long short-term memory network that were been introduced in the LSTM has been around since 97. The GRU in 2014. The GRU is often works better with less training data and has fewer parameters and is simpler, but the LSTM is more established. And so there tends to be a preference towards the more established one. Now, in the last, I don't know, call it 7 years or so, there's been a whole further set of architectures developed. One based on an idea that's been very effective for images called convolutional neural networks. That same architecture can be applied to sequences. There are dilated networks, which are ways to sparsify the convolutional neural network. That's been very effective for speech generation, for example. Attention has been really important for natural language processing. And then finally, transformers is kind of even more recent in there. And it also includes a kind of a key layer, the attention process. I put the equation down here, which one we'll recognize as not even just bilinear, but it's nonlinear, but it's got trilinear elements. It does a bilinear element of a soft, essentially implementing a soft key value store with a query, but it's done in a soft way with continuous functions rather than the way we typically think of a key value store. All right, so that's how you would apply first a standard neural network like a recurrent network to any one of those quantitative finance sequence processing tasks that we've seen before. And there are many architectures that have evolved since the basic network in things like recurrent networks and LSTMs up to these most recent networks. And these are all really effective in forecasting problems. But there are other types of sequence processing that is kind of important and applicable to things in quantitative finance. And one of these is referred to as reinforcement learning. And reinforcement learning basically recognizes that when we participate in a market, our actions actually affect the market. And so what is reinforcement learning? It's an end-to-end method to optimize sequential decision-making tasks to maximize a cumulative reward. It's a technique that's been applied in games recently with extremely good success in things like chess, in playing Go, in playing video games like Atari and Dota too, in these games. The rewards in these cases is far out. It's the single reward of have you won or lost. In finance, the rewards come a little faster. How well did the trade go? And how well did it forecast? And in the markets, when we go out and buy something, when I gave the example of buying Apple, large amount of it, we're going to affect the market, and being able to make decision-making in a world where we're affecting the market is where reinforcement learning might come in. Now, reinforcement learning isn't easy to do. It requires really good simulators and game playing. It comes for free almost, requires software, and requires a lot of computation. So it's an area that is of extreme interest and research in the area. All right, so let me conclude before going to Q&A by commenting that many parts of the investment pipeline require inference over sequences. Deep neural networks can be trained to implement these parts of the sequence. For this to work well at scale, at a place like 2 Sigma, we need lots of data, and a place like 2 Sigma has over 10,000 different data sources and ingests 20 petabytes of data annually, not just that simple price sequence, but all those other areas where we extract features. Lots of computation to train these networks, but to also store all that data and process all that data. Distributed software infrastructures for doing inference and training over those networks. And of course, what a place like Two Sigma needs is lots of creative and smart people to work on these problems. So I've talked longer than I had expected, so I'm going to jump straight over to Q&A. I think there's a bunch of questions that have been asked, and I'll let Andrew take over now.
Okay, thank you, David. Let's move on to the Q&A. Just a quick note, I think I'll say at the start of this, I'm going to be somewhat selective as to what questions I pass forward to David, just to respect intellectual property and other such concerns. So the first question is, does the value of the dollar figure into these calculations, that is inflation a relevant factor here? So when you're looking across your sequences, you have prices, but maybe those prices actually mean different things at different periods in time.
Yeah, so across time, they'll mean something. Obviously, within a given timestamp, they are going, given time, everything is relative to the current rate of inflation. Whether invariably there are certain financial decisions that will depend on inflation. There's other things that come out of what we've even talked about, is where do you get the money from? Do you leverage it? Do you leverage the money that you have to actually trade more than you actually have? What is the interest rate going to be to pay for that? So those are, I call those more finance challenges than deep learning challenges. Within a neural network, honestly, I haven't thought about incorporating an estimate of inflation as one of the inputs. So thank you for the idea.
Okay. Next question is just the general feature importance question. How do you decide which features to input, which are more important and which are less important?
Sure. So, that usually comes through two parts. One is a hypothesis-driven approach, where there's reasons to believe that something might be important just because that's what we kind of know from non-algorithmic methods. And then the other part, and so those will be candidates for incorporation into one of these neural network alpha models. And then there's a lot of experimentation. There is incorporate it, see how well it works, ablate that feature, see how well it works without that feature, and make that decision using historical data. So that's referred to sometimes as back testing. You put, you evaluate, you don't know what the future is going to be, and you have to have some degree of faith or belief that the past is a good indicator of what the future is. It may be an incomplete picture of the future, but it's the only information that we have to go with. And so a lot of that is experimental in deciding which feature to use. Other things might be, how often can you actually get the feature? Is it something that happens once a year? It's not going to be very useful if you're going to try to do high-speed forecasting. Or is it something that's available readily? And that's be another factor.
Okay, thanks. Next question. And I'm going to read this literally and then maybe paraphrase it a little. How do the algorithms adapt to permanent market fluctuations due to independent events happening, say invention of new technology, war in Ukraine, or a depletion of a resource? These kinds of events usually cannot be predicted through information we already have, like how much oil is sitting inside reserves, but are influenced. So I'm going to take this as, what if there are regime shifts? So a sequence used to work a certain way, but now the world is different. How do we handle that?
Sure. So there are, there's a variety of techniques to do sort of domain transfer for an adaptation. These are used in not just in finance, but if you're doing image process or recognition and you try a different camera that has different properties, you have to be, you hope you have methods that are going to be adaptive to those techniques. However, and there are some parts of trading that will be kind of independent to the larger domain shifts. What happens at, say, a high frequency, the trading that goes back and forth in seconds, may not really depend a lot on the overall market. However, those might be dependent on a new player comes in. And so there are shifts of that type. There are, the term hedge fund comes about because the way that hedge funds initially were approached was to be independent of the way the actual market was going. So you would short the market so that you could basically only make decisions that are going to be independent of the way the overall market is going. So if you think there are certain things that are going to go up relative to the market, you can short the market and long the positions of interest. So there are ways to be insensitive as an overall strategy to it. However, in a perfect world, you had something that actually would be insensitive to those domain shifts. And that doesn't, that's a challenge for everybody.
Right. How would the algorithms take qualitative features into account, i.e. features like quality of management or employee satisfaction?
So those are, depends upon where you get that might be thought of as a form of fundamental data. Those can be really fed in directly as features like any other feature, and kind of evaluate it if you have a clear way to kind of correlate the impact of those measures to the way the stock actually moves, and whether you can kind of extract that correlation from enough data. One of the challenges with that is often some of this fundamental data, and to even a greater extent, the kind of data that was just referred to, is that you get that information very infrequently. And so you don't have a good way to model from many, many examples the impact of it. And it might be coincidentally correlated with other things that are happening. So when you have little data, neural networks often overfit to the data, and that overfitting, one of the manifestations of it is finding coincidental correlations between some of the features. And so that can be a challenge for using that kind of data.
Okay. I believe you touched upon this briefly during your talk already, but what do you see as the future of reinforcement learning for finance? How does it perform versus deep learning?
Okay. So I think, the jury is still out. It's an area of active research. And to be honest, a lot of the stuff doesn't get published. The financial industry tends to be secretive, to be, full disclosure on this, that the secrets are kind of kept close. So, but it's an area where it's something where, many firms, Two Sigma included, do research and use reinforcement learning as one of many, many techniques, with 1,600 researchers or people at Two Sigma and many researchers doing this. Pretty much, if you said, is X being used, the answer would be yes. Somebody is doing it. So it is out there. And it's one of the tools in the tool chest that we use.
Yeah. Here's another one. Deep learning models require a lot more data compared to classical ML, and also tend to overfit. How do we offset that?
Right. So the place where it works best is going to be where there is a lot of data. So if you're going to apply this to a small market that only has a few instruments, it's hard to generalize across instruments with limited amount of data. If it doesn't trade very frequently, or the data only shows up infrequently, it may be difficult to apply it. So at higher frequencies, you're likely to have more success with deep learning methods. If something is like the art market, where a piece of artwork doesn't trade very frequently, it's going to be very difficult to apply a learning-based method. Whereas in something like US equities, where there are thousands of equities traded in the US, 3,000, 4,000 actively traded, and a longer tail of inactive ones, and trading continuously for hours, there's a fair bit of data that does arrive. So.
Yes. How do we know in practice that the distribution in inference is going to be similar to what we trained on?
We don't. Yes, this goes back to the earlier question as well on this topic. You hope you can pick things that will, maybe things will look kind of similar intraday, but may look kind of different between days. And certainly there are times when, there's the rise of the retail trader and GameStop, which, had an impact on quantitative investments, because the behavior of the market, at least around a moderate number of stocks, kind of changed from what it was previously. And that is something that challenges quantitative methods in general.
Great. What about missing data? So you've got a sequence and you've got several points in the sequence, but then there are, perhaps there are missing gaps. There are gaps within that time series.
Sure. So sometimes you can incorporate a mask as an input. If you expect the data to be infrequently available, you might have a mask that sits along with the input data. The other possibility is to impute the missing numbers. That is itself a prediction problem. If there's like we miss one price point because there was a lightning strike somewhere and some server had a reset, and we miss a few timestamps, we could look at the neighborhood timestamps and fill in those missing values.
Great. Perhaps a more philosophical question here. Do you agree that deep learning is not equivalent to, quote, deep understanding? These methods are curve fitting rather than coming up with deeper insights. Is that a concern?
I'm sympathetic to that question. Largely what is being done is a neural network is a function. Learning and training is estimating the parameters of that function. And that function is, has a certain performance characteristics. It might provide the appearance of being smarter than it actually is. It may also say that many things that we do are not as smart as we thought they were. So it kind of cuts both ways. That sort of this various skill learning and stuff like that is in many ways the same thing of recognizing patterns and applying the lessons of those patterns in a consistent way. So it's a great question. It's one of those ones that if we were together, I would say, let's go out and share a drink and talk about it, and probably not get anywhere, but we'll either agree or not disagree.
Great. One other one I'm seeing here is about explainability. How much is this kind of related to this somewhat? How much is explainable AI something to consider here?
What I've talked about had nothing that was explainable. It was a black box. In fact, I was going to show a book about where I got where I did some of the learning about the investment pipeline that I showed you is called Inside the Black Box. And much of what is going on in there is not directly explainable. You can explain what layers are doing and why they might output in terms of things that you might understand, but often it's not explainable. And so the question is, do you value the explanation more than the results? And sometimes explainability may have a cost. To add in explainable layers in there and to put things in terms of intermediate results that are explainable may cause a degradation of performance. And, some people will value, or some situation will value explainability over accuracy or effectiveness, because that explainability is extremely important. But what we've shown here does not include explainability as a factor.
Okay, great. Well, I'm afraid we've run out of time for today. I'd like to thank David again for his informative presentation and insightful answers to the many questions. Special thanks to each of you for taking the time to attend and participate today. This talk was recorded and will be available online in a few days at learning.acm.org. You can find announcements on upcoming talks and other ACM activities at learning.acm.org and acm.org. Also, please fill out our quick survey where you can suggest future topics or speakers, which you should see on your screen in a moment. On behalf of the ACM, David Kriegman, and myself, Andrew Rosenfeld, Thanks again for joining us, and I hope you'll join us again in the future. This concludes the talk.